Welcome back to the Economic Analyst channel. In this video, I'm going to give a little bit of a breakdown of the Producer Price Index report that came out for April of 2022. So the report was updated a couple of weeks ago, and I apologize for the hefty delay on this. I know you were waiting, but there's a couple of things to go over on this. So one is that the final demand numbers dropped, which was to be expected when we received the CPI index report numbers, and they came in underneath expectations and the recent trends, and final demands came out with a month-over-month change of just over 0.5%. That's the lowest change that we have seen since September of 2021, and largely this has to do with the fall in, relative fall in energy prices, and I think that a lot of that has to do with the Biden administration releasing some of the strategic oil reserve, combined with the fact that the month of April in the northern hemisphere is usually a very seasonally mild month for weather and climate. So demands for energy, for usage, for utilities, and cooling and heating is probably going to have a little bit of a fluctuation on the price. But the seasonally adjusted numbers on the Producer Price Index and the Consumer Price Index should account for that, or at least partially account for that. Nevertheless, we got a fairly low 0.5%, and this is still relatively low. But however, this is masking the problems that are still going on in the commodities index fund. So when we look at the Producer Price Index for commodities, it jumped by a whopping 2% month over month, and that's been the trend since 2022. There was a little bit of a drop back in December of 2021. We've gotten this bounce back, and that's certainly pointing to the fact that we're still having a lot more inflation to come. So the idea that inflation has peaked is very misleading. It most likely has not, and we will see price indices start moving up on an aggregate level, not just on an absolute level, but on a year-over-year change. We have not seen the peak in the Consumer Price Index and the Producer Price Index yet. So for final demand, the year-over-year change did drop from 11.5 to 11.03, but because commodities are still showing a yearly annual change of at least 25 to almost 30% year-over-year inflation, then more than likely that is going to show up in higher final demand numbers, which will press on in higher consumer prices over the summer, and then we're going to have increased energy consumption over the summer, which will lead to more inflation in the fall. So annualized on the commodity index for producer prices, the Producer Price Index for all commodities did rise from 20.6 to 21.5% year over year. Just still hasn't reached its peak from November 21 of 22.7% year over year, yet we're seeing this elevated, very much elevated and continuously elevated price inflation for the producer prices that we have not seen since the 1970s during the oil embargo crisis and the first wave of gas shortages and food shortages inside of the United States. So it's likely to be a repeat of what happened here with systemically high price inflation soon to follow on this. And conventional economics tends to concentrate way too much on the labor expenses. And although labor expenses are not going to reach the levels of commodity price inflation, as I've pointed out, and I'll show you again in my business expense index, you have to average the two to really get the look for the CPI. And it's showing that the Consumer Price Index will likely push over 10% annualized inflation rates sometime over the summer, if not this fall or by the end of the year. Looking at the expenditure category, we can see that what held the final demand was at 0.5% was services. Okay, so services was flat, and while transportation and warehousing was pushing up, trade kind of held things down. But when you take a look at just goods price inflation, food, energy, and core demand goods, we see here that they are 1% plus above. So the fact that the index is weighted and it's a relatively fixed weight, and I know that sounds like an oxymoron, but the weight changes slowly over time. But it does not reflect consumer behavior like the personal consumption expenditures tries to move to. we can see here that, we're seeing lots of high prices in demand for goods. And, while services are still holding things down, and that's kind of masking the real price inflation problems that are systemic inside of our economy. Now, in my last video, which I came out almost 2 weeks ago, I pointed out how the CPI index report missed, and it was because of low energy prices. It's the fact that the energy prices actually surprisingly dropped, even though now we're seeing oil prices go up on the rebounds. That will likely point to a positive consumer price index number, a very positive number this month. The producer price index did drop by 0.5%. Factoring that in for next month, we're probably looking at the CPI doing a sharp rebound and pressing up by about 1.1%, a little bit over 1%, and we will see the CPI retest its peak at 8.6%. That's what the model's showing right now. I know that may seem kind of shocking when last month we only got a 0.3% jump, but absent of the Biden administration dumping more oil reserves, and they're trying to release more oil reserves to depress gas prices. If oil prices continue the way they are and we're seeing this trend, we're likely to see this 1% increase. Even accounting for that strategic oil reserves, we should be pricing this in now inside of the index numbers. So more than likely, we're going to see this 1% jump in consumer prices, even if we get a tame energy price sector, okay? So just keep on the lookout for that. I'll post updates, obviously, when the consumer price indices come out in the next 3 to 4 weeks. But more than likely, we're going to see a retest of the peak. If not, we'll see consumer price index inflation numbers, still rebound and increase up to that 8.6 number. We'll see how that transpires. At the minimum, it will, we'll see a 0.6% in price inflation, and that might show that there's a continual decline, but that's really masking the systemic problems going on in our economy. And again, more than likely that will be caused by energy prices remaining relatively tame due to an influx of artificial supply from the federal government. When we take a look and extrapolate the producer price index inflation moving out to the rest of the year, it does not look good for consumer prices. As I've noted before, there's a strong correlation between final demand prices and the consumer price index since the final demand index was created back in late 2009. Extrapolating out the growth for the average and the median over the last 3 months reveals that we could see final demand, unless if we start seeing a change in momentum in the trend, push 14% by the end of this year. Now, there is a lag right now going on between final demand prices and the consumer price index, but even if we factor in that the consumer prices might be 2 to 3% below the final demand year-over-year inflation, that's still pointing to a CPI of 10+%. Looking at the commodity prices, they also corroborate this, and actually the trend on commodity prices points to an even worse inflation rate than the final demand. Why? Because when we take a look at the average and the median trend for the last 3 months for commodity prices, they're looking at, unless if we start seeing a flattening or peaking in commodity prices right now, if it continues at a growth rate of 2.3%, commodity prices are going to reach record highs and push over 30% by the end of this year. Now, do I think that we're going to hit this 30% price inflation by the end of this year? Probably not. But even if we don't, and say we hit or stay around 20%, you have to remember the CPI is half commodity, half wage inflation. So half of producer price index inflation, half of 20% is 10% price inflation. We'll likely see that in the CPI. And so once again, that corroborates the idea that we're going to see price inflation rise for the remainder of this year until we start seeing on the commodity levels, start seeing commodity prices start to peak and we start seeing pressures on wage inflation subside. So this is the business expense index versus the CPI. I've extrapolated it out through the rest of 2022, but you can see that the year-over-year inflation between the business expense index in orange versus the actual CPI in blue shows a strong correlation. And although there is a lag between the consumer price index year-over-year inflation and the peaks of growth in the business expense index, they tend to cancel each other out between the peaks and the lulls. Nevertheless, what's going on with the business expense index? Well, factoring in a 3.4% wage increase for year-over-year, which I think is, pretty conservative and probably more or less accurate, we'll be looking at the business expense index inflation of about 14%, and then trying to, account for lags in the CPI. That's pointing to a CPI of 11.5%. Now, once again, that's factoring in that producer prices are going to reach, commodities are going to reach 30 to 32% year-over-year commodity price inflation by the end of the year. Again, that's just showing you the trend. It's not telling you, it's not giving you the actual prediction of what's yet to come. There's really no way to tell about this other than to look at the trend and say, hey, this is what's been happening over the past few months. If it continues on like this, this is likely what we'll see by the end of the year. So once again, just to recap one last time, has price inflation peaked? No. No, it hasn't, almost unequivocally. Could we see another month or two of, relative drops in the year-over-year CPI? Yes. Yes, we could. We might see it for the next month-over-month drops. But what we won't see is over time, we will not see a calming down in this consumer price inflation till we start seeing commodity prices peak. Soon as I start seeing those commodity prices peak and level off over the next few months, I'm not coming off of this bearish prediction on high consumer prices and the implications that has in our economy. I will post more videos giving my thoughts on certain market dynamics, such as the value of the dollar, the trade deficit, how the role of inflation, what does it mean for Federal Reserve interest rates and monetary policy, and how that's going to affect fiscal policy going forward. Expect those videos to come out very shortly, sometime after Memorial Day. I'll probably release another video before Memorial Day giving some of my thoughts on this, but there's a lot of implications that goes into with these high consumer prices and what that means for our economy today. Thank you guys for watching this video. I hope you enjoy the content that I provide. If you do, you can always show me support by leaving a positive comment down below, or just let me know what you think and your thoughts on this. Click that like button on this video. Subscribe to my channel if you haven't already. And as always, you can click that notification bell so that way you are notified on your portable device as soon as I do upload a new video. Once again, guys, I thank you for watching this video, and I'll talk to you next time.